Hello viewers, and in this video we'll be going over the S&P 500 ETF ticker symbol SPY. In this video we'll be going over the day-by-day probability model as well as how we found the forecast model and the S&P forecast. So first let's go over the technical analysis. Today we are down 48 basis points. On the 1 hour chart we were touching over sold RSI earlier in the morning. However, see a convergence on the 1 hour MACD and we may head positive on the MACD soon. As for the 4 hour chart, we are still on the positive MACD. We saw a divergence earlier in the morning and we began to see a possible convergence later in the afternoon. As for the daily chart, we're still very near the overbought RSI and we see a slight divergence on the daily MACD. So if we expand out, so the next resistance that I see is where we made the all-time highs of yesterday around the price of $324.89. As for support, I see the 18-day moving average acting as our support. Reason why? We see a price concentration around this range. So since we are above resistance, that act as our support now. So that is around the price of $319.80. So if we were to move up higher, that price movement is roughly around 50 basis points. And to the downside, it is around 1% to the downside. So back to the forecast model. This is now available in the link below, so do check it out. So let's head to the day-by-day probability model. On here, we see as we progress the days, we see a tight concentration between one standard deviation down and one standard deviation up. And we see a slight in favor of standard deviation down from 0 to 2% down, but a lower chance of 2% to 5% down. However, on the other side, 2 standard deviation up, 11%, higher than the 5% that we see 2 standard deviation down. Overall, it's slightly in favor of downside. If you calculate all of these models, is equivalent to 50-50% chance on day 7. So back to the day-by-day forecast model on here. So what we have here, we have 1 day out, 2 days out, 3 days out, 4 days out, 5 days out, 6 days out, and 7 days out. So which one of these models we should focus on? Ideally, the model that is the best match to the current trend. Right here we have the current trend, and below is the trend I believe is the best match. This trend dates back to January 10th to April 5th to 2012. So let me point out why these two charts are similar. So what we have in the beginning of the trend, we average above the middle Bollinger Band. Next, we made a slight dip below the middle Bollinger Band at this instance. Next, we see another continuation of the uptrend, averaging above the middle Bollinger Band as well. So on the trend in question, we start to see a similar pattern. We see average above the middle Bollinger Band. Next, we see a slight dip below the middle Bollinger Band. Next, we see average again right towards the end, above the middle Bollinger Band. So what we have is 1, 2, 3 points. We also have 1, 2, 3 points. So there's a reason to believe that the trends and patterns are the same. The outcome and forecast should be fairly the same for the S&P 500. So the trend that we just examined was January 10th to April 5th, 2012. Back then, the S&P 500 was down roughly around 56 basis points. So not much to the downside, a slight dip considering what happened overnight with the US drone strike on Iranian general. So overall, we may see a slight dip in the next coming days. So once again, this forecast model is now available in the link below, so do check it out. If you enjoyed this content, feel free to like, comment, subscribe, and thank you for watching.